From a near total collapse of the global banking system to the arrest of Sam Bankman-Fried to BlackRock, of all companies, becoming a vocal advocate for Bitcoin, 2023 has had no shortage of critical events related to Bitcoin and the broader macroeconomic landscape. After starting the year with a price of roughly $16,000, Bitcoin has more than doubled, reaching a price of $35,000 at the time of recording. A year that began with bears stomping on Bitcoin's grave quickly turned into one that Bitcoiners will never forget, with broader sentiment now more bullish than ever before. This is your 2023 Bitcoin and Macro Recap. Before diving into what went down this year, we should set the stage of where the market was at going into 2023. In 2022, everything was working against Bitcoin, starting with the beginning of the current Fed hiking cycle all the way back in March of 2022 when they raised the Fed funds rate by 25 basis points. Persistent rate hikes from the Fed drove asset prices down across the board, not just Bitcoin, but stocks and bonds as well. The declining Bitcoin price quickly exposed the over-leveraged actors within the space. You know the age-old Buffett quote, "Only when the tide goes out do you discover who's been swimming naked." The first domino to fall was Terra, an algorithmic stablecoin supposedly backed by its companion crypto token, Luna. The collapse of Terra and Luna led to a contagion of insolvencies across crypto-native investment funds and exchanges. BlockFi, Celsius, Voyager, and other rehypothecating exchanges were exposed before the culmination of the contagion when the largest crypto exchange in the world, FTX, went down in November of 2022. Fresh off the FTX implosion, Bitcoin headed into 2023 with a price of roughly $16,000.
What's Bitcoin at? 16,000? It has another 17,000 to go down. There's no intrinsic value to this asset.
On the macro side of things, US Treasury yields were at near all-time highs. Meanwhile, CPI, while in decline, still remained at historically high levels. Declining CPI, also known as disinflation, is not to be confused with deflation. With disinflation, prices are still rising, just at a slower rate. The compounding nature of CPI meant that inflation would remain a key problem throughout 2023, with Fed rate cuts highly unlikely, as suggested by the heightened bond yields. A declining purchasing managers index and an inverted yield curve signaled that a recession in 2023 was highly likely. With the stage now set, let's dive in. It did not take long for Bitcoin to start regaining steam. By January 14th, Bitcoin was already back above 20,000. On-chain data once again signaled the market bottom with near impeccable accuracy. When the price of BTC is beneath the aggregate cost basis of long-term holders, that is a strong sign that BTC is undervalued. Aside from BTC coming off the lows of 16,000, the first 2 months of the year were relatively uneventful, but everything changed in March. Due to the inverted relationship between bond yields and bond prices, rising yields meant that bond prices were plummeting, specifically long duration 10, 20, and 30-year bonds. Banks that used customer deposits to purchase long duration bonds back when yields were less than 1% were now significantly underwater, being forced to sell their bonds at a loss in order to meet customer deposits. As concerns around the solvency of major banks spread, a rush for deposits ensued, an event commonly known as a bank run. This exacerbated the problem and resulted in the 4 largest bank failures of all time. Signature Bank, First Republic Bank, Silicon Valley Bank, and Credit Suisse all collapsed. With the entire fractional reserve banking system getting exposed, the Federal Reserve had no choice but to intervene in order to prevent the total collapse of the global banking system. In order to prevent distressed banks from having to sell bonds at a loss, the Fed created a program called BTFP, which stands for the Bank Term Funding Program, or as I like to call it, Backstop the Fiat Ponzi. This program allowed banks to borrow money from the Fed equal to the price they paid for the bond rather than the now lower market value of the bond. This would be like if you bought Bitcoin at 69,000 and you were allowed to borrow against it as if Bitcoin was still trading for 69,000 instead of 35,000. While BTFP allowed the Fed to stop the banking system from collapsing, the cracks induced by the Fed's maniacal rate hiking crusade were beginning to show. Despite that, the Fed has done a 25 basis point rate hike 3 more times throughout the year. In the wake of the banking crisis, Bitcoin ripped from 20K to 30K, a 50% increase in just a 1-month period. This should come as no surprise, as banking insolvencies do a great job of highlighting Bitcoin's value proposition as a bearer asset with zero counterparty risk. Moreover, the Bank Term Funding Program injected over $100 billion of new liquidity into the market. The bond market reacted precipitously to the bank failures, with yields plummeting across the board. The 2-year yield dropped from over 5% to under 4% in just 3 trading days. However, after the Fed's May meeting, in which Jerome Powell remained firmly hawkish, yields began climbing once again and have continued to do so throughout the year. Also in Q2, we saw the craze of Ordinals and Inscriptions on the Bitcoin blockchain. This was a hotly contested issue within the Bitcoin community. In one camp, people were claiming that inscriptions were a denial of service attack on the Bitcoin network, while others espoused that minting pictures of wizards on the blockchain is a totally legitimate usage and that quote-unquote rare Satoshis are more valuable. A majority of Bitcoiners probably exist somewhere in between these ends of the spectrum. Regardless of where you stand on the question of whether or not inscriptions should be allowed, there are 2 key implications that the inscription craze brought to light. First, Bitcoin miners will for sure be able to survive off of transaction fees as the block subsidy trends towards zero. Bitcoin is the most secure database in the world. Being able to submit an immutable transaction or inscribe an image or a piece of text into that database is something that people are willing to pay for. And with block size effectively capped at roughly 4 megabytes, when demand for this database of truth increases, users will have to bid higher transaction fees in order to incentivize Bitcoin miners to include their transactions within the limited block space. With miners briefly earning more revenue from transaction fees than they did from the 6.25 BTC block subsidy, during a bear market, mind you, we can only imagine how much miners will be raking in from transaction fees during an institutionally driven bull market. Second, ultimately the highest and best use case of the Bitcoin blockchain is for uncensorable third-party free financial transactions and wealth preservation. Considering the ordinal craze happened during the midst of a bear market, the group inscribing wizard pictures didn't have many users to outbid in order to get their transactions into the blocks. Despite that, fees still went parabolic and they quickly burned through their funds. As Bitcoin gets adopted by large-scale institutions for means of financial settlement, it will be very difficult for users to justify spending the transaction fees necessary in order to place a picture on the blockchain. Throughout this time period, the BTC price trended sideways to down up until June, when it was announced that BlackRock, Fidelity, and others were applying for a spot Bitcoin ETF. Before we get into that, I should remind you of what happened 1 week before the ETF announcement. The SEC sued both Coinbase and Binance for the brokering of unregistered securities. In hindsight, this was clearly an attempt by the SEC to clean up fraud within the industry and provide the regulatory clarity that institutional investors have been waiting for. The SEC made a clear distinction between Bitcoin and crypto as asset classes. Bitcoin is a commodity and crypto is full of securities.
If you understood securities law, like you couldn't buy a penny because they're unregistered securities, which means they're being manipulated in an unethical fashion by a central party.
A clear legal precedent was set that any entity wishing to deal with crypto must be registered as a licensed security broker. The SEC clarifying their position on this matter signaled to institutional investors that Bitcoin, not crypto, is where they are safe to deploy capital. Less than a week after the SEC filed these lawsuits is when we found out about the Bitcoin spot ETF. The initial response by the market was one of exuberance. Bitcoin ripped from 25K to 30K within a matter of days. However, after the initial excitement wore off, BTC grinded sideways throughout Q3 as questions arose about the timeline of ETF approval, with analysts unsure that approval would happen during this calendar year. Crabbish price action remained the status quo until the fateful Monday morning of October 16th. Cointelegraph falsely reported that the spot ETF had been officially approved and was ready for trading. Within minutes, Bitcoin pumped 10% from 27 to 30,000, only to come back down just as fast once word spread that the rumor was false. However, the market's response was telling, and soon the inevitability of a spot ETF and the implications thereof began to set in. Over the next couple weeks, BTC would climb north of 35,000, making new year-to-date highs, which is roughly where we sit at the time of making this video. You may have noticed that I haven't mentioned the stock market once throughout this entire video, and that's because aside from bank stocks getting hammered during the crisis, with some of their charts looking like altcoins, the equity market hasn't really been interesting this year, especially in comparison to the Bitcoin and Treasury markets. The US stock market is up on the year, but that's been driven primarily by a handful of tech Goliaths, with Nvidia, Meta, and Tesla each posting over 100% returns year to date. Overall market breadth is low, with low and mid-cap stocks having an abysmal performance. You can see this by looking at the Russell 2000, an ETF that tracks such companies. Overall, major stock indices like the S&P 500 and NASDAQ have drastically underperformed BTC during 2023. And the high correlation that we saw between BTC and risk assets during 2020, 2021, and 2022 has begun to subside, with frequent periods in which BTC went up while risk assets traded sideways, or BTC went sideways while risk assets traded down. We're definitely starting to see signs of the decoupling that Bitcoiners have been talking about for years. This is happening because fundamentally, Bitcoin is not a risk asset, although it has historically traded like one. While producing this video, we've just received news of a settlement between CZ, Binance, and the SEC. CZ has pled guilty to money laundering charges and has stepped down as the CEO of Binance. He faces up to 18 months in federal prison and will have to pay a personal fine of $50 million, while Binance will have to pay a fine of $4.3 billion.
Go to federal prison. Federal prison.
At this point, it is clear that US regulators are adamant on eliminating the fraud and market manipulation induced by offshore crypto exchanges, doing so in order to pave the way for BlackRock, Fidelity, and others to begin shuffling their clients into the Bitcoin market. Overall, the spot ETF in the anticipation of institutions entering the Bitcoin market has been the most dominant theme throughout 2023. There are mixed feelings in the community about the arrival of BlackRock and other large traditional finance entities into the Bitcoin market, but their arrival was inevitable, and it won't stop Bitcoin from disrupting the fiat monetary system. In fact, this provides all the more confirmation that Bitcoin is doing just that. In 2017, BlackRock CEO Larry Fink called Bitcoin,
"It just identifies how much money laundering there is being done in the world."
And now he has become a vocal advocate. Sure, his intentions likely aren't great. He probably doesn't align ideologically with much of what Bitcoin stands for, and he's probably just in it to make fees off the ETF. But the point still stands. Wall Street has capitulated to the existence of Bitcoin. They understand that Bitcoin is indestructible, immutable, digital scarcity that can be owned in an unconfiscatable way. There's no getting rid of it, no way to stop it from working, and no way to prevent people from using it. Now that they've recognized that fact, they're making their best possible move, which is not to ignore Bitcoin, but rather to embrace it. These ETFs are going to bring an enormous amount of capital into the space, which will drive true Bitcoin adoption because fundamentally, an increase in price, or number go up, is what brings the most amount of new people into Bitcoin. Lastly, Bitcoin owned through the spot ETF is not real Bitcoin. You only own Bitcoin if you are in control of the private keys. That being said, most people, especially wealthy baby boomers, are not ready to take such a step. The spot ETF is perfect for these types of people because it allows them to have Bitcoin exposure through platforms they are already familiar with. Over time, I expect self-custody, specifically collaborative multisig, to become the standard. There are a ton of great companies out there building user-friendly multi-sig products, which will be the perfect solution for individuals and institutions alike. Collaborative multi-sig solves many of the issues that people and institutions face when dealing with the self-custody of Bitcoin. Having multiple keys distributed across multiple parties is perfect for institutions because it prevents one single person from running off with or losing the Bitcoin. And it's also great for individuals and families because it provides security against $5 wrench attacks, as well as a plan of action for passing Bitcoin to your heirs after you pass away. If you want to learn more about multi-sig and collaborative Bitcoin custody, then I recommend you check out this podcast I recorded with Peter Dunworth. The last point on the spot ETF is that there are concerns that the issuers will do rehypothecation, selling more Bitcoin than what is in the ETF in order to suppress the price. I think this is of no concern for a few reasons. First, those running the ETFs will make fees off of it, so they are actually incentivized for the Bitcoin price to increase, as that will result in more trading volume. Second, due to many different institutions launching their own respective ETFs, there's going to be a game theory component to this. Some institutions may choose to be incredibly transparent, publicizing the address that contains the Bitcoin in order to incentivize capital to come into their ETF over their competitors. Lastly, FTX did engage in rehypothecation in paper Bitcoin, and we all saw how that turned out. They barely existed for 3 years before their scheme went up in flames. Unlike gold, which has suffered from rehypothecation for all of human history, Bitcoin has the digital component working to its advantage. As soon as word spreads about potential rehypothecation, millions of users can demand redemption of the Bitcoin from the custodian in minutes, creating a very potent virtual bank run. 2023 has been an exciting year for Bitcoin, and 2024 is likely to be even crazier. If you're eager to see what we think will happen in 2024, then subscribe and click the notification bell because that video is coming soon.